All right, so thanks again for being here, and let's get started. So we're going to talk about some really great high reward, low risk option strategies, the butterfly and the long condor. So a little background, I've been actively trading for over 40 years, started my trading career back in the 80s on the oil side, and quickly moved up into the ranks of some different companies, but ended up with a company called Trans World Oil, and at that time it's the largest oil trading company in the world. That with Fibro and Mark Rich, and fantastic experience. So that's where I got introduced to options back in about 1987, and just been passionate about the option side of things ever since. So we're going to dive into how to incorporate the use of these kind of two strategies, the butterfly and the long condor, and what makes them really work, and especially in this kind of market environment. So the following presentation here today is purely for educational purposes. Any stocks, options, or futures mentioned does not constitute advice and should not be construed as a recommendation. Now, to me, when you look at trading, what works, the secret to trading profits, whatever, it really comes down to direction, timing, and then option for your risk management. So we call that, a lot of times we'll call it opportunistic risk management, because the options can give us so many different flexibility type of things that we can do to hedge or decrease our risk, increase our leverage, things like that. So they're really an instrument that can be very opportunistic for our trading or even investing. So, I've been trading options now for over 30 years and have found that the most valuable go-to option strategies can really help any trader more than any other trading strategy, and especially during times of real extreme market uncertainty, are the option butterfly and the long condor. So they're kind of what I refer to as my secret trading weapon. Now, the huge advantage that you get with these two strategies is their unique option framework. So it's designed to take advantage of time decay, theta, and volatility, which are two main option pricing components. Now, this really helps to stack the trading odds in your favor. And these strategies can be used in any type of market environment, but they're really, a very, very good ideal strategy when we get into higher market volatility and uncertainty, and higher volatility in general. So if you just know when and how to use them, they're going to be one of your, best go-to strategies. Now, the thing that makes them so great is the structure. Okay. So they're structured to require only a small amount of your, hard-earned capital. So your trading returns can be very explosive. So that's the thing that is so great with these strategies. We can get our cost of capital on a trade super low, but the leverage is still very, very high. And so they're basically a debit type spread type trade. So it's kind of what I refer to as kind of lightning in a bottle. So if you could find what makes a great trade, bottle it up, that's what we're looking for, lightning in the bottle. And these two strategies can kind of provide that excitement. Now, the butterflies and long condors, they're very dynamic, and they can be traded for a variety of different reasons with different goals in mind. So in other words, once you learn how to trade the butterfly or long condor, you're going to be covered for your offense and your defense of your trading. So your goals and protections. So they're a great way to make profit, but also a great way to hedge. Now, these two strategies, they can work no matter what the markets are doing. They can be an up, down, sideways market environment, can provide income from stocks that are going nowhere, helps really to eliminate the stress of having to be perfect on a stock's direction or overall market, eliminates the time decay expense that you're going to encounter from decaying long options, takes the unsettling guesswork out of your trading, and can be structured for very low cost, low capital at risk type trades. And you can get, potential returns of 10 to 1 or higher. So, potentially risk $1 to make 10. So they've got a really great structure as far as risk reward ratio kind of parameters there. Now, the other thing that's super great about these two strategies is they can be used for hedging. So when you mess it up, you're going to have some trades that go against you. This is one way that you can have a kind of a fast, low cost way to cover your, pronto when a position starts moving against you. And I've literally found no other hedging strategy that comes close to incorporating these two on a core position. So by constructing either a butterfly or a long condor around a strike that is under pressure, from another core trade, such as if you did a credit spread or a debit spread, becomes really one of the best ways I've found to immediately neutralize, but not only neutralize, but lower the risk of your trade. And so, one of my members, Pam, she said, I wish I'd known how to do this hedging before I lost so much money on credit spreads. And that's so true. If you've done credit spreads, once it goes through your short strike, you can, really give up a lot of your returns. So there's a great way to hedge credit spreads by either, hedging it with a butterfly or a long condor. Now, when we look at the butterfly, the construction, here's a good example of just kind of the simplicity really of it. So here's an example like of a call debit spread. So you're long a call here, short a call, and the cost of the trade is $300. So that's your total risk exposure right there is $300. Now you can see this right here. Your long would be that 1,010, and your short here is 1,020. So this is a $1,000 wide spread, and your cost is $300. And so your potential theoretical profit would be $700. So nice positive risk ratio, but we can reduce our risk if we wanted to. From 300, we could drop it down quite a bit. All we need to do is adjust it to either a long call condor or a butterfly by selling the opposite side of the spread. So that's what's so great about it. And we can do this so fast. We can implement this kind of hedging strategy. Now this is what then makes the butterfly. So if you look here, and we added a credit spread side to it. So we sell the call, buy another call here, same spread width right here, 1020 on the short strike, and then long to 1030. We've now brought in a credit in this example of $200 right here. So we've gone from that risk of 300, we've dropped that down by bringing that credit of 200, and now we've constructed a balanced butterfly, and we've reduced that risk down to 1,000. Down to 100. But the really big key thing too is to notice that based on this lowered risk, we've got a huge potential return of $900. So, that's what really gives you the great leverage. Now, if it goes out anywhere in here, we can participate in profit. But if it goes out at the top of the tent, that's where you make your max profit, and that would be 900. So, basically risking $1 to make 900 is not a bad day's work if you can get that one to work out. Now, the other thing that is just the kind of the cousin of it, I call it, is the long condor. So instead of, having the exact same short strike sharing here and make it a really kind of tight, kind of thread the needle, we can widen out the spread here, make it a bigger profit zone. And that's what we call a long condor. So we can do this with calls or puts. And so this is what kind of the first thing I go to if, hedging something. I'll start out usually with a long condor, and then I can adjust down to a butterfly if I need to. So it's a really great quick way to, cover yourself. Now, the next thing let's take a look at is, what makes the butterfly and the long condor really work and the dynamic of it. So the most important option factor when we look at the butterfly and long condor comes down to understanding, again, how option pricing works and the concept of time decay or theta, and the effect that it has on the price of your option. So when we look at theta, what it does, it tells us how much an option price is going to go down over time. So that's the rate of your time decay of your stock option. And this time decay occurs because the extrinsic value or time value is going to go down and increase the closer you get to expiration. So it really starts to accelerate. So that's a really big thing that we can take advantage of when we're doing a butterfly or condor, because we've got that sell side component, which is actually selling time and volatility. So let's take a look at the construction here real quick. So if we look at the butterfly, here's an example taking butterfly here, the XYZ is trading at $45, and we're looking for just a directional move in this example to 43. Now we can easily do this with a low risk trade by, buying, let's say, the September 44 put, and that's going to cost, in this example, $238. Then we sell the 43 put against it, sell another 43 put against it, and buy that 42. So what we've done is created a butterfly, and this is the body of the butterfly where you're short the credit spread side of it. So now we've created this really narrow wing butterfly. So you can see with this trade, we've got $238 debit, $1.06 here, and then we brought in credit $1.67 twice, times 100 to make it into option spread contract. So our risk here is $10. That's the max we could lose. Now the profit though is if you take your 43 less your 42, your bottom, the 43, the mid strike, and the 42, you can see it's a dollar wide spread less the cost of the trade, 10 cents. So your potential profit is the difference of 90 cents or $90 per spread. So that's where you get these really high levered returns based on using either a butterfly or the Condor. So in this example, you can see you've got a potential to make 900% return or risk $1 to make 9. So as far as any of the option spreads, this is the one that will give you the biggest and best return doing this kind of spread strategy. So let's take a look at some of the better, structures. There's a variety of these. So let's take a look at how they work. Now, to me, when I, talk to my members and clients, one major goal, in my opinion, for all traders or investors is to select trades that are going to be based on what's going to give you the most consistent positive returns over time with low defined risk, and not always the greatest return. So, not always that home run. So I always look at risk first, and let's say we can just hit singles and doubles, and occasionally you're going to make the home run. So one of the best ways to do this and achieve this is by being aware of what are the different option strategies available to you, then to understand how they each work, and then select the one that's going to be best suited for you, for the market environment you're trading, or just for your specific trading goals. So everybody here, have different risk parameters based on their capital that they're trading and their time to trade, et cetera. So what I found is these two strategies are great for any type of trader. Small traders or big hedge funds can trade these option strategies, and the results are all the same from the leverage that you get and the reduced risk. Now, when we look at the different variations, it's kind of like the butterfly family. We've got the variations of either you can use long calls or put butterfly, a broken wing call or put butterfly, the ninja, which I call that's the unbalanced ratio butterfly, iron butterfly, and hedging. Okay, and then we've got the other one I kind of consider the cousin, which is the long condor. So these are the variations, and so we can structure these based on the market we're trading. So we can do broken wings, we can do ratios. Gives you a lot of different flexibility once you understand how to structure these types of trades. So I thought what we do next is go through kind of a review of some trades so you can see how they work and get a better kind of feel for how these strategies will work. So let's take a look first at the butterfly. Now, the other great thing, we can control and adjust our risk by the wingspan of the butterfly. So, the analogy is if you're, trying to collect butterflies, it's going to be a lot easier to get a butterfly, capture it if you've got a big wide net, right, versus a small net. So the same concept with the butterfly. If we want to get a bigger profit zone, we just widen out the butterfly wings, and we have that bigger zone for profit. Or if we want to really tighten up our risk, we just can narrow that butterfly right there and have potential for a huge return, but on super low risk. So that's controlling that risk based on the wingspan of the butterfly. So we're going to take a look here first of a narrow wing butterfly with a $10, $100 wide spread width. And the other great thing with butterflies, we do a lot of these typically with ETFs. They're great for SPY, QQQ, the Russell, any of the ETFs like home builders or whatever you're interested in trading. We can do that with the butterfly or long condor. So here's an example of a narrow wing butterfly. And so this was on SPY, and we were looking for the target. It was trading at 267 right here. And we were looking just for up here to 273, this area here. That was a Fibonacci retracement level, which I like to use. And then we had some moving average and option activity right in there. So it gave us a really good target. So what we want to do is when I put together what the target I'm looking to achieve, and that's typically the body of the butterfly. So in this example, we were looking for 273, so that's going to be the body of the butterfly in this example. And what we did was we bought the 272 call right here, sold at 273, and then sold it again, and then bought the 274. So we've created a narrow wing butterfly with the max risk of $10. Now the potential profit, if you take, your, one option contract's equivalent to 100 shares. So that's 100 shares or 100 minus your cost, 10 cents. So theoretically, if it went out exactly at the body of the butterfly expiration, you'd make 900% return. Now in this example, it went out up $70 per spread. That's a 700% return. So you can see that these really give you this kind of magnified potential return. So, you might say, somebody asks you how you did on your trade today. You might say, well, I just made a 700% return. They might think you're lying, but these are the actual types of potential returns that you can, get using these strategies. So that's an example of the narrowing. Now, you can see here it goes out at the top of the tip, pretty close, but not perfect, but close enough right there. So this went from, when it's trading at 273.08, right there going into expiration on the 16th, this went from down here 10 cents or $10 up to 80 cents or $80. So there's your profit of $70 per spread on that risk of $10. That's your 700% return in a very short period of time. So love to use these for shorter duration. I'll typically, go out a week. You can do it one day if you want, just for a day trade and keep your risk super low, but have good returns. But typically go 1-2 weeks out is kind of the time frame that we're looking at typically on these types of strategies to take advantage of that accelerated theta decay that we get out from the spread. Now the next one let's take a look at is a wide wing butterfly. So this is typically what we tend to use because it's going to give us a bigger, wider profit zone. Great for defined risk. We know exactly what our risk is going in. Great for hedging. Used for targeted directional swing trades. So that's primarily how I use it. So if we think a directional move to the upside or downside is going to happen, we put together what is our target going to be, and then structure the butterfly or condor based on that targeted price. Also great for pinning trades. That's where, you have an expiration and it might go out a certain strike. We call that pinning. So it's a great way to play pins for option expiration. Great for high volatility markets because we're selling volatility basically. So the higher the volatility, also, the more premium we bring in. Great way to play high price stocks that are maybe too expensive for you to buy shares, but we can control those stocks for very little money using these structures. Trade duration, you can do it as little as 1 day up to 2 weeks are typical. Always going to give you positive data, no time decay, and your return on capital of 2 to 1, 10 to 1, sometimes even higher than that. So here's an example on QQQ. So we did this short trade here with a QQQ butterfly. So this is a wide wing butterfly. So it was $10 wide or $1,000 per spread. So the trade, I've got an alert service, and you can see this was sent out to the as an alert. So in this trade, you can see it was new QQQ short trading at 314.60, cycle high retracement reversal. So buy a butterfly, the 26th August, that's your expiration date, 314.304 through 294. So $10 wide spread. So it was set up, it was traded at 314.60. Now the max cost or max risk there is your debit paid. In this example was $210. So that's kind of a walk through there. And then what it did at expiration was it came off really hard and almost hit right into the target and was up $790 or maximum potential profit, excuse me, if you nailed it perfectly at that short strike would be 790. So you can see that'd be over 376% return. So here was the trade setup when we did it. It was trading right here, and we were looking at targeting down here to this area down here to this 304. So we wanted a wide body butterfly in case it went there, but we still participate in the profit. All right, so that's kind of what it looked like going into the trade. And then here's what the setup looked like. So this was buying the put. So we're doing it with put, looking for a downside move. So bought the August 26th strike series. 314 put, sold the 304, $10 wide spread there, and then sold the 304 put, bought the 294, 10 there. So we had this wide body balanced butterfly. So $10 wide spread, so that's $1,000. Cost of the trade was $210 right here, $2.10 debit, so 210. So theoretically, if you nailed it perfectly at 304, you'd be up 790 per spread, 376% return. So that's what it would, to the optimum of it. Now you'll never get it perfect because it's hard to, get it perfect at that butterfly target, but you'll get pretty close. But by doing it wide, you've got a lot of profit zone here to work with. So you can see the huge zone of profit. Now, here it was going into expiration, so very little time left in volatility. So it's going out here on the 26th, which was expiration, right there at 306. So the target was 304, but this is close enough because we have this wide body butterfly to take advantage of it. So this went out up, $572 on that risk of 210, so up 272% return based on where it was going out there. So if you did just the shares, and they moved down, you had made 3.6% per share gain. But in this one, if you did the butterfly, you've got 72% return. So just no comparison as far as risk reward on the trade setup itself. So here's another good example to show you how time and volatility work for you. So this is a wide body butterfly on Amazon, and this is a $10 or $1,000 wide spread. So it was good support right here about 1763, where it was trading 1782. We're looking for just a move up to this 1830 level right there. So wanted to do, a cheap way to trade it versus having to buy the shares. So if you went out and bought 100 shares of Amazon in this example, that you'd be paying $178,200 for 100 shares. But we did a butterfly, and we were able to control the same type of potential directional upside move for just a fraction of the cost of the trade. So here's the trade setup, what it looked like. So in this example, option expiration was the 6th of September, set up on the 29th of August. And so went out and we were targeting this 1830 level right there. So bought the 1820 call, sold the 1830, sold the 1830, bought the 1840. So $10 wide spread or $1,000. Look at the cost of the trade, 80 cents. So 80 cents to control 100 shares of this if it goes up. And the potential profit theoretically would be the difference of $920, a 1,150% return. So risk $1 to make $11.50 versus if you just the shares, look at the expense of the shares, you'd be out, $178,200 to do 100 shares. Now, if you hit your target of 1830, you made $48 per share profit, but look at the return on your capital at risk. That'd be only a 2.69% return versus this one, if you nailed it perfectly, it'd be over 1,000%. So next thing, let me show you what it looks like the same day and how volatility and time work to your benefit. So here it was going out the same expiration day, the 6th, and this was in the early morning, about 9:30 or 10. So at this point in time, it was trading right here at 1836. So it overshot the target we were looking at for 1830. But based on that price where it was trading, in the morning, this was up 150 bucks. So that's why it's great, because we can still participate. So we're up $150 on that risk of 80. So this at that point in time was up 187% return. Now the same day, just about 3 or 4 hours later though, you're going to see a huge improvement. See all that black area? That's what's still left of the price made up of time that you sold in volatility. So you've got a potential for a lot of profit right there. So about 3 hours later, the same trade was now 4 times more. So at this point, it was trading a little bit closer to your profit zone, but you can see that the volatility is getting really stripped out. The time is getting stripped out, very little left. So this went from, up 187, so now it was up $614 or it was up 769% return versus your stock gain if you did stock at 2.69% return. So it went from $80 to $695, so 4 times more, and that was the same day. So that's the beauty of it, taking advantage of by selling that time and selling that volatility component of the trade. Now here's another favorite I wanted to show you here. This is what we call the long condor. So we can do this structure for moves up or down by either using calls or puts. And what we do is similar to butterfly, but we're getting that bigger profit zone. So instead of that really tight butterfly thread the needle here, we can widen out the spread width and have a bigger profit zone. So a really great way to play an upside or downside move and have a wider profit zone, but also have a very low risk trade with positive data. So again, we get the wider profit zone, define risk, great for directional trades, really great when high volatility because we're selling time and volatility in the trade structure. Got to give you positive data, returns of 2 to 1, 4 to 1, kind of our basic returns there. So this was on Valero, an oil stock. So again, alert trade setup that we did, and this was back on the 17th of August. It was traded at 116.94. So started this trade out as a call debit spread, and then we adjusted it when the price moved up to a long call condor. So let me walk you through how this worked for this trade structure. So here it was trading right there, and this was again an alert trade sent out to our alert members. So it's trading right here at 116.94, right there. And we were looking for a move, a breakout. That's what we call a volatility squeeze. So we had a number of different profit target take areas. So right here, profit take, profit take, profit take there. So when it was trading 116.94, traded up to 121.75 right here. It was a max profit. So this trade started out here. Look at the cost of the trade. This just kind of shows you the profile of how, risk profile here. So your total cost of the trade was $107. The potential profit would be $293. So you can see this was a kind of 117 call, long, short the 121, and then the 126, 130. So it's a call debit spread, and then a call credit spread, and that creates your, in this example, a long call condor. So by doing this, we've got this huge profit zone. So here it was on the, this was the 17th was entry, and then on the 19th, took some profit right here. And at that point in time, with your risk of 107, this was up $63, $64. But $64 on your risk of 107, that's a 60% return. So you can see how you get great returns, but very low capital at risk. So that was 2 days later. And then here you can see a few days later, it started moving up, started pulling out that time decay and volatility, starting to pull out. So here it was trading on the 25th, it was trading right here, right there at, was trading 122.94. So when it was trading right there on the 25th, this was now up $225 per spread right here on that risk of 107. So it went from 107 to 333. So it's up our spread was up $226 or 211% return. And then it even gets better. So if it goes out here at expiration between your short strikes, that's your maximum profit. So the next day on the 26th, that's exactly what happened. It was able to go out and expire at expiration right there at 121.75. So that's between your two short strikes. So the perfect zone right there. So here's your short call on the debit spread, short call on the credit spread, and it goes out between here. So you make max profit on your debit spread, make max profit on your credit spread. So this was up here $293 per spread on that risk of 107. So there's your return of 274. So again, potential for huge returns on very low risk. Now, the other great thing is we can do, really great hedging. So here's an example of hedging out a long put debit spread and adjusting it to a long put Condor into what we call a free trade. So this example was another alert trade we set up. This was started out as a put debit spread, and then we adjusted it to a long put Condor and captured back the premium. So going into the trade, we had a premium that we were out on a debit spread right here of $121. So this was long a put debit spread. So our total max cost was 121. That's the risk. And then we were able to, when it moved down hard, we sold a bull put credit spread, recaptured that $121 that we had debit costs, actually captured more. And this was, we received a credit and no risk at that point. So we went from here, I'll show you. So here's the move down. So hit down. So what you want to do here is think a couple, 2 or 3 steps ahead. And then we knew that, okay, if we do get a move down here, can we recapture and bring back in the debit costs or even maybe more? So it hit hard down here. So it was trading at 365. And then we adjusted it on the first when it was trading at 354 right here into a put Condor. And so this is what it looks like. So here's your original trade was your put debit spread. So long here, the 364 put, short the 360, $4 wide spread, cost of the trade, $121. Really nice potential return, $279, a 230% return, not bad. But what we want to do is see if we can turn this into a free trade and increase our positive theta. So when it traded down to 354, we were able to do that by selling a bull put credit spread. And this is what it ended up looking like. So originally trade 1 was we were long the put debit spread. Okay, so we were long the 364, 360 put debit spread, $1.21 debit cost. But then when it sold off hard, we sold, and this was on the first, we adjusted it. So sold, it was trading at 354. So we were able to sell the 354 put, buy the 350 put, brought in a $1.41 credit. So now we're into the trade free. We've got actually a $20 credit on the trade. Now it ended up going out between our short strikes, so it was a max profit. So here was our, put debit spread side, long the put, short the put, and then we had the bull put credit spread here, short the put, long the put, and it went out right between the two. So we kept everything, kept the debit, kept the full, max profit on the put debit spread, max profit on the credit spread. So you can see here, the debit spread was 121 up to 400. So you had your profit there. And then we had that credit of 141 and it went to 0. So kept that. So there's your profit on that type of trade from that. So let me see here. So you can see that the profit going out here was, it was trading at 359.67, and that profit then was $420 per spread, but on 0 risk. We actually had a credit. So if it had just gone straight up or straight down, up outside of our zone, we'd still make $20. So just a really cool trade structure and setup once you understand how to do the spreads. So that's a look. So you can see here your potential profile. You can see it here, $420 max profit, trade cost, 0 is a credit actually here. So credit 20, potential profit potential 420 on that kind of structure, if you adjusted it. So, just want to really show everybody here, these two strategies, how they work. And if you'd like to learn more on, how to master these high reward, low risk option strategies that can work in any market environment, especially extreme market environments, I'll be doing a workshop on these, not this weekend, which is Labor Day, but the weekend after. So let me go through the program and take any questions. So this will be for Saturday, the 10th of September, start 11 a.m. to 2 p.m. Eastern, and then we'll finish up Monday at 5 p.m. to 7 p.m. So this course gives you a great course package. I've got two packages to lay out for you tonight. And here's package one. Let me give you the link here. So you should be able to click on that. It's right here, powercycletrading.com/butterfly. So let me click on it, make sure it works. And okay, yeah. So here's your payment link here. If you want to do package one, you'll get the full 5-hour course and all the bonuses. I've got a great bonus package for you. So let me go through that. So with this package one, let's start off. So course package one, you will get the 5-hour live course, which will be everything recorded, broken down in modules. The course will be yours, forever, as long as you want it. You'll have access to it into your trading vault where you'll access your courses. So you'll get the course there live and recorded. Then I'm going to give you my Fibonacci price target mapping course, which is what we use to project out, forecast where the targets are we're trying to achieve. So that's on the website, $397. So you'll get that, and then you're going to get my Start Trading Options Today course, kind of a intermediate beginners course. You'll get that to kind of get you rolling, and then 30-day trial membership to the Power Cycle Trading Club. And you can start this whenever you want. You don't have to start it right away. You can start it, whenever you finish the course or before whatever. So you can start that, and then we'll do a live follow-up Q&A, support Q&A there, which will be live and recorded. Then I'm going to give you my option trading tutorial, which is another option guide of the delta, gamma, theta probabilities, and a 15 option strategy manifesto to show you some other really great option strategies. So a really nice value package here. Everything up here totals up to over $2,600, and it's yours today for $197. So use that link that I just gave you right here. And if you want to add to it our trading club, which is trading club and alert service, which gives you my trade alerts that are sent out, you can do it with this elite open and close trade alert service package that I have. And this is course package 2. So if you've been looking for, ways to get more help and guidance in your trading, so you don't have to be glued watching the screen all day trying to pick the trades, this is what I do for you. And I do then send out 4 different potential types of trades. So you'll get the potential types of trades or alerts that I send out are right here. So either butterfly long condors, counter diagonals, breakout trades, which are debit spreads, and earnings trades. So there's selective earnings trades we do. So there are 4 different kinds of potential trades that I'll send out. So you're going to get the alert service. You'll get this for the next 3 months, but then you'll get an additional month of the trading club. So we have 3 months of the alerts, and then, hopefully you'll renew, but if you don't, you'll still get 1 extra month to the trading club, plus everything in course package 1, all the bonuses and all the goodies there. So if you like this one, it's powercycletrading.com/alert butterfly. And let me give you that link real quick, make it easier for you on that. So here's the link to that one. Let me put that in right here. So powercycletrading.com/alert butterfly. Click on that one, make sure it works for you. And here it is. So there's 2 pay if you like it, $607. So that gives you everything in package 1, all the bonuses, everything. And then you're going to get the alerts for 3 months and the trading club for 4 months. So if you break it down, that comes out to about, what is that? If we take out 607 minus 197, it's 410. So you're looking at $136 a month to get, everything, all my alerts, the course package, the trading club. So really great deal there. Now with the alert service package, you get, again, 3 months of the alert services, 4 months of the trading club, live course, all bonuses, $607. So what you're going to get with this package, you'll have access to the trade setup alerts for the next 3 months, typically 10 to 20 stocks a month, stocks and ETFs. So selected butterfly or condors, counter diagonals, breakout trades are usually done with debit spreads, either put or call debit spreads, and then selective earnings trades that we usually do on this one, double calendars. So you'll get a trading guide, what option strategy to use, option series. I do a trading setup video after the close. You know, if we do a earnings trade or let's say an alert trade, you'll get that video to show you how, you know, why it was done, how it was done. The trades are all listed in archives, so you can go back and look at it. So then you'll have access for the next 4 months, the trading close. So that'll give you my live weekly Q&A every Tuesday, which is live and recorded for the next 4 months. Market video newsletter. So every day after the close, I do a video update, what the markets are doing, you know, my perspective on things. You'll have that for the next 4 months. And then access to my virtual trading room every day during the week. So you can come in and ask questions, see what we're doing there, and, you know, have coaching or mentoring there, and just ask whatever trade questions you have. So you'll have that for the next 4 months, and then 60% discount on all my trading software and courses. So the other thing too, you can stop and, you know, pause this at whenever you want. So if you go on vacation or something, you can start or pause your time so we're not counted to it, and then let us know. We'll start you back on the clock. And again, you can start this after the course. You don't have to start it today. So here's kind of a summary of what we've done to date. So started the 4 services, the first one back in May of 2018. So all 4 together, cumulative results, we've had 502 trades closed out, 388 winners, 17 break evens, 97 losers, 81%, you know, rate of winning trades. Now these are unaudited, but this is a summary that I keep track of the trades, you know, win losers and break evens to show you the kind of that trading performance there. So that's on the cumulative, and then breaking it down. Here's the breakdown of the butterfly. We've had 102 closed out, 77 winners, 5 break evens, 20 losing trades, 80% winning rate there. And these are really great returns. Typically, you'll always have the biggest, you know, the loss on these potential would be 500 to, you know, typically 100 maybe max kind of loss on the debit cost, or when we, you know, we're to stop out. Your average return is going to be 2 to 4 to 1, typically on a butterfly long condor. The calendar diagonals, started this back in June of 2019. We've had 147 trades closed out, 116 winners, 3 break even, 28 losers, 81% win rate here. Breakout trades were the first one I started, so this was back in May 2018. Had 156 closed out, 115 wins, 6 break even, 35 losers, 78% win rate there. And then the earnings trades, these are selective earnings trades. Typically what we're doing now is just what we call a double calendar. And started this back in June of 2019. We've had 97 closed, 80 winners, 3 break even, 14 losers, 86% win rate there. So really great winning percentage on these alerts that are sent out. Now with the course, we're going to start out, I like to go through the option Greeks, you know, the vitals of those and how they affect the butterfly long condor. So the impact of theta decay, impact of volatility, the importance and how it works on the price, you know, to make the butterfly long condor work. So you'll have a really good understanding of how these internals work to make these trades, you know, successful. And then option pricing, very important to understand how option pricing works. So we'll go through that in quite a bit of detail. And then we're going to cover the Fibonacci price target mapping. Now you're going to get my bonus as a bonus course, this price target mapping course, but we'll go through, you know, in the course trade examples based on using target mapping and standard deviation for selecting our, you know, directional price targets. So that's part of the course there to learn how to do that. And so that's part 1. And then we're going to go to, if I can get rid of this pen, part 2 is where we're going to jump into the various variations. So we're going to go through each variation of how, why, and when would you use the long call or put butterfly, wide wing butterfly, broken wing butterfly, ratio butterfly, broken wing ratio butterfly, iron butterfly, vacation butterfly, and long condor. So it's like a Bubba Gump shrimp, but we're going to do all the different variations. So in the course, we'll go through with examples, not live, but past examples of doing these different structures or variations. So you'll have a clear understanding of which to use, when to use it, and how to use it. So then we'll look at what are the best time frames. Should you go out, 1 day, 2 weeks, 3 weeks to use, for your butterfly timing wise? What stocks or ETFs are the best ones? Even index options we can do these on, or even futures if you want to do that. You can do everything with options based on these two strategies. So how do you get the profit from that volatility collapse and theta decay? How do you structure the setups where you can get that 10 to 1 or higher? So how that works. And then a really fun part of it is monthly option expiration, or what we call pinning. So we'll go through a couple of really great examples of what we call these pinning trades. So these are based on monthly options. So 12 times a year, you have the potential to make these option pinning plays. And we do these using typically butterflies. So for pinning price targets, using butterflies and condors. So a really great kind of additional income stream that you can do there. So that's in that. And then we'll get into the long condor. What are the major trading advantages of the long condor, where we get the 100, 200, 300% return. So again, a low capital at risk, high positive theta, but a wider profit zone. So how, why, and when to use the long condor for, either upside move, downside move. So go through great detail on that. And then the last part of the course is probably the best part, is hedging. So in this kind of crazy market, you want to understand and know how to quickly hedge. So go through, take you through the progressions of hedging. Then we go through how to use the butterfly long condor to hedge a core position. And then how to use the butterfly condor to defend vertical spreads, typically the credit spread. So there's a great credit spread defense using the butterfly that I'll teach you in the course. Then step-by-step checklist of when, how, and when to put the butterfly and put them on and take them off. Execution, adjustment, risk management, resources, exchange, trade, funds used. What is assignment risk, expiration risk, auto exercise. So just cover everything that's going to possibly could affect you, and then you'll get a trading library, a 58-page trade library of past butterfly and long condor trades you can go through and go back and kick the tires on those. And a lot of times that's the best way to learn, is looking at past trades. So a little feedback here, Larry. You're the only one that I know of that provides competent, realistic instruction on how to have a Houdini escape hatch plan to utilize when various types of option trades go against you. It allows a trader to calmly use their head to make appropriate trade adjustments instead of wildly panicking and having their heads handed to them. So that's so true. When things start getting rough, a lot of times you might panic, but if you know what to do, you're not going to panic and let your emotions get in. So, let your head be handed to you. So I always remember that from what Richard said here. I greatly appreciate you sharing your hard-earned profitable trading knowledge and techniques, Richard. So here's the bonuses that you'll get. Again, everybody will get these bonuses. So you'll get my price target mapping course, which I did back in February. So relatively fresh course here. So it's a 3-hour course just strictly on what I call price target mapping, which is using Fibonacci, price analysis, moving averages, price support resistance levels, standard deviation, and unusual option activity. So this course goes through the combination of these put together to create this price target mapping that we use to target, map out our price targets for profit or defense. So you'll get that as a bonus. And then you'll get special bonus 2 is start trading options. So this is a on-demand option beginners course, get you started trading options. If you're just starting out, this is a great way to get started here, and then add the butterflies and everything to it. So comprehensive, easy to understand option trading. So great introductory course for you. So the benefits of options versus stocks, must know option basics, and then mastering puts versus calls. And then go through 2 really great strategies, kind of beginner intermediate, which is the covered call and then what we call the protective collar strategy. So that's gone over in great detail in that course for you. And then you'll get one trial month membership to my trading club. Again, you can start this whenever you want. If you do the alert package, you'll get this for the next 4 months. But if you do package 1, you'll get a trial membership 30 days. So we have a virtual trading room open each day during the week, 9:30 to 10:30 Eastern, Monday through Friday. I do a video newsletter every day after the close. Videos are archived. My trades are archived, so you can go back and look at them. Live weekly Q&A, which is live and recorded. I've got a really nice traders educational vault for some really good trading information. Free stuff there for all members, and discounts on 60% off on any course or software on my website. So really great bonus there for you. Just kind of get you rolling and give you some more additional mentoring and support. And so bonus 4, then we'll do a live follow-up Q&A, which we'll do this probably the next day on Tuesday. So this will be live and then recorded. Plus you get the virtual trading room for the next 30 days. So that gives you that additional support there. So combination of that, just want to make sure we cover everything for you to make sure you understand these trades. Now you'll also get my option trading tutorial, so 60-page option guide with videos on the Greeks, pricing options, market maker secrets, standard deviation, option delta, and probabilities. So another great option course here for you to kind of get you up the ladder. And then last but not least, my top 15 option strategy guide. So, what is a back ratio spread? So this takes you through what is the trade construction, when would you use a back ratio spread, a long straddle or short straddle, short strangles, etc. So another great thing to add to your library of options. And then the elite open and close alert service is what you're going to get here. Just go through this real quick. So this is one of my members, Wally. He said, Larry, I have to mention one thing. I'm subscribed to a lot of services who send out trade alerts. Some are good, others are not that great. But one thing that I would like to have people on this webinar know is that when I get a trade alert from Larry, I do it blindly. As time to show me this man is dead accurate with his recommendations. Thanks, Wally. And Scott, one of my good old members here, said it will be the best investment that you will ever make. Go with the elite package, great group of traders as well. So again, just to review here, you'll get all this for the price of $607. And there is a 2-pay if you want that. Let me give you the link again real quick here. So it's right here. So this would be the alert package. So you get everything for 3 months, the alerts for 3 months, 4 months to the trading club, and everything in package 1. All bonuses. And again, you can stop, pause, whatever you want during the course of your membership or member access to the alert service if you go on vacation. So, butterflies, calendars, breakout, earnings, trades, all 4 of these kind of categories. When I send out an alert, you get this suggestion option trade. A lot of members do their own thing, but I'll always give you an option trade. So I'll give you what the entry level is, profit targets, what we're looking at there, what option series to use, stop loss guidelines, and then any adjustments, I'll send those out by text. So constantly updating you, usually during most of the day. So you'll get all that. I do a trade setup video of any that we do that day. You'll get that market newsletter after the close. You'll get access to weekly Q&As for the next 4 months, virtual trading room, discounts, traders educational vault. So here's kind of what it looks like. Here's what we did today. We had used what we call Telegram. So here was today. This is XHV short trading around 60.13 if long. The 61 put short that 59 put, taking some profit here if you have multiple contracts. So that was alert trades kind of sent out there. And then here was one on new XRT. So we did a short trade here today on XRT, which is a retail ETF. So that's kind of what that looks like. These go out just within seconds of when I put the trade together. So that's a look there, what it looks like. I showed you the results here. So really good high probability winning rate on these trades. And let's go through. I'll show you a couple more examples here. Here's a butterfly. Showed you this is the long call Condor. Showed you this earlier. This was on Valero. So set it up right here. Had multiple profit takes. And so it went out max profit on the last day right up here. It was up $293 per spread, 274% return there. Here was the QQQ short trade one we did back in April. This was another put butterfly. So right here, trade set up right here, hit right down to our target zone right there. So this one was a huge winner. So went out right here, trading up $427 on your risk of 165, so 259% return there. Here's a counter diagonal example. This is what we just did recently. This was on Phillips 66. And so we did this with a call counter diagonal. So got in right here, took it off right there. So this went out, $430 up to $590, up $160 per spread there, 37% return on that in 3 days. And breakout trade example, this was a long put debit spread back in May. So just did just a nice debit spread here for a breakdown. And it happened, it went down so smooth and fast that we didn't do any kind of adjustment. So really nice trade. Had a max risk here of $280 and $346 profit, 124% return there. And then an earnings trade, we're doing typically what we call double counters. This is one we did on T-Mobile. And these are just basically for selling volatility and time. So this volatility collapse strategy, so it's this what we call a double counter. These are very low risk, low risk trades, high winning percentage trades. So this one we set up with a, max at risk $124 and went out with a profit of $131. Here you saw the volatility collapse, 105% return in 3 days on that. So that's pretty much everything. Any questions? Here's the link again for the package 2, and then I'll give you package 1. And if you have any questions, please feel free to ask. So here's package 2 again. And